Welcome to COB channel. Today we're going to talk about cost volume profit or CVP analysis. Cost volume profit analysis emphasizes the interrelationships of cost, quantity sold, and price. It is a valuable tool in identifying the extent and magnitude of the economic trouble a company is facing and helping pinpoint the necessary solution. It allows managers to conduct sensitivity analysis by examining the impact of various price or cost levels on profit. It is an integral part of financial planning and decision making, and it is used as a short run decision making tool. As part of the cost volume profit analysis, we will use the break-even point. Break-even point is the point in the volume of activity where the organization's revenues and expenses are equal. In other words, total revenues must equal total costs. Or rather, there's neither profit nor net loss. So the net profit or net loss should equal to zero. So that is what break-even point analysis is. Now to now to make this in more detail, we will show you the variable costing system. Variable cost system tells that sales less variable cost is equals to contribution margin less fixed cost and is equal to net income or net loss. Now, why do we have variable costs here and not both variable cost and fixed cost? Because variable cost, the behavior of the variable cost is dependent on the number of sales or number of goods sold with respective to sales. Now, fixed cost, regardless of how many items you have sold or how many items you have produced, the cost will remain the same. And that is what break-even point analysis is. We have to equal the contribution margin to the fixed cost in order to get a break-even point or a net income or net loss of zero. So just remember the distinction between the variable cost and the fixed cost. The distinction is that their behavior. Variable cost is changes relative to the number of sales or number of goods sold, while for the fixed cost it remains fixed regardless of how many units or items you have sold or produced. Now moving on, we're going to present you the formulas for the break-even point analysis. Now if you were asked for the break-even point in units, the formula is break-even point is equals to fixed cost divided by the contribution margin per unit. So highlight that per unit. Now if you are asked to look for the break-even point in sales dollars or rather in currency, the break-even point is fixed cost divided by the contribution margin ratio. Now to get the contribution margin ratio, you have to divide the contribution margin all over the sales, and you'll get the percentage ratio of contribution margin. And with that, we can move on to the illustration. Next. We have here an example for break-even point. Polar Company's projected profit for the coming year 2020 is as follows. We're given with the sales, variable expenses, contribution margin, fixed expenses, operating income. So this will be an easy for you guys to compute since the total sales, total amount, and also the per unit are already given. So we're asked to compute for the break-even point in units and in dollar sales. Now let's do this. As what we have said earlier, break-even point in units, when we want to calculate a in units break-even point, you have to know the fixed cost, which is already given, and divided by contribution margin per unit. And with that, this is the solution. So fixed cost of $64,000 divided by $8 per unit contribution margin, I will get a 8,000 units break-even point. So you should get at least a minimum of 8,000 units in order to break even or recover the cost. And beyond that, you'll get a profit. Now let's calculate the break-even point in dollars. In dollars of sales, you have to calculate the contribution margin ratio. Now the contribution margin ratio is the contribution margin divided by the sales. So here is the solution. So $64,000 divided by the ratio of 40%. and we'll get a break-even point in dollars of sales of $160,000. So you can calculate also this as well, break-even point in units of 8,000 times the selling price of 20, and you'll get also the same answer. So that is for the break-even point analysis. The next slide will show you the assumptions of the cost volume profit analysis. With that, we have here assumptions of cost volume profit analysis presented here. First, the analysis assumes a linear revenue function and a linear cost function. Second, the analysis assumes that price, total fixed costs, and unit variable costs can be accurately identified and remain constant over the relevant range. Third, the analysis assumes that what is produced is sold. Fourth, for multiple product analysis, the sales mix is assumed to be known. And fifth, the selling prices and costs are assumed to be known with certainty. Next is margin of safety, which will be discussed next. Now, what is margin of safety? Margin of safety, it is the units sold or expected to be sold, or the revenue earned or expected to be earned above the break-even volume. Now, presented here are the formulas for margin of safety, both in dollars and in units. Now, for in dollars, it is the difference between the sales and the break-even sales, and for in units, it is units sold less break-even in units. Now, margin of safety is a crude measure of risk. The further above the break-even point, the larger the margin of safety, and the further the company is away from break-even and a loss. Now, presented next in this slide is an example of margin of safety. Now, Philtrex Incorporated provides photocopying services. Next year, Philtrex estimates it will copy 2,800,000 pages 800,000 pages at a price of $0.08 each in the coming year. Product costs include the following. Now, in here, there is no variable selling expenses. Fixed selling and administrative expenses total $46,000. Now, we are required here to calculate the following. Break-even point in units, break-even point in sales revenue, margin of safety in units for the coming year, and margin of safety in sales revenue for the coming year. Now, we're going to answer this one by one. Before we answer number 1 and number 2, do take note of the following given presented in the problem. So you may opt to rewind this video in order to refresh yourself what the problems are in this what are the given in this problem. Now to answer before we answer number 1 and number 2, recall first the formula given for the break even in units and in dollars. Now for break even in units, it is equals to total fixed cost divided by contribution margin per unit, and for in sales or dollars, it is equal to break even in units calculated in number 1 times the selling price, or total fixed cost divided by contribution margin ratio. Now with that, we have recalled the formulas for break even. Now let's answer number 1. Number 1, to calculate total fixed cost, which is 80,000, we have here in the given $80,000 for total fixed overhead and fixed selling and administrative expenses, which is $46,000. That's the total fixed cost. That's only these two are the only fixed costs that we have in this problem. So total those two will get a $126,000. And for the contribution margin, we have no variable selling expenses, and the variable expenses that we have here in this problem are the following: direct materials, direct labor, and variable overhead. Get the sum of those three, we'll get the total variable expenses, which is $0.02. Now get the difference of the selling price and the variable expenses. 0.08 minus 0.02 will get a 0.06 contribution margin per unit. Now applying the formula, total fixed cost divided by contribution margin per unit, as we calculated, will generate a total break-even in units of 2,000, rather 2,100,000 units or pages. Now for number 2, we can opt to use the formula number 1, which is break even in units as we calculated in solution number 1, or rather number 1, times the selling price, or the other formula, which is total fixed cost divided by contribution margin ratio. Now let's first calculate the contribution margin ratio. Contribution margin ratio is equals to 0.06 contribution margin divided by the selling price, which is 0.08. Now with that, we can calculate use the break-even in sales dollars using both formulas. Now presented here is the solution. 2,100,000 in units times 0.08 selling price will have a break-even in sales dollars of $168,000. Using the second formula, total fixed cost, $126,000 divided by contribution margin ratio will also generate the same answer, $168,000. With that, we can already calculate the margin of safety in dollars and in units as required for number 3 and number 4. Now recall first the formula for margin of safety in dollars and in units. Now presented here is the formula in order to refresh you. Now for in dollars, it is equals to sales minus break even in sales, and in units, units sold minus break even in units. Now for number 3, we are required to calculate the margin of safety in units. So it is already given in the problem the number of units sold, which is 2,800,000 units, less that units we have calculated in number 1, which is 2,100,000 in units. It will generate a margin of safety in units of 700,000 units. Now for number 4, we can calculate the sales for this company, Philtrex, even though it is not given the problem. Now recall that the Philtrex has sold 2,800,000 pages times the selling price given already, which is 0.08, will generate a sales of $224,000 less the calculated we have in number 2, which is the break-even sales, $168,000, and the difference will get a margin of safety in dollars of $56,000. Now next, we'll discuss about the operating leverage. Now what is operating leverage? Operating leverage is the use of fixed costs to extract higher percentage changes in profits as sales activity changes. The greater the degree of operating leverage, the more the changes in sales activity will affect profits. It also refers to the structure of your costs. Now to calculate the operating leverage, we have here the degree of operating leverage. It can be measured for a given level of sales by taking the ratio of total contribution margin to profit as follows. Degree of operating leverage is equal to total contribution margin divided by the profit. And also the percentage of change in operating income is equal to degree of operating leverage times the percentage change in sales. Financial analysts uses this valuable piece of information that can be used to quickly determine the impact of a percentage change in sales on operating income. In other words, how your income will increase with a relative increase in sales will be told or expressed by the degree of operating leverage. To understand this more, let's do another example. Recall in the previous first example in break-even analysis. So for your convenience, it is also presented here. Polar Company's projected profit for the coming year 2020 is as follows. Now, we are asked to compute for the degree of operating leverage, and if the upcoming year it is expected that sales will increase by 20%, by how much in percentage would operating income increase? Now, to answer these requirements, recall that the degree of operating leverage is equals to total contribution margin divided by the profit. We were given the profit of operating income, which is $16,000, and the contribution margin as presented in the problem is $80,000. We'll get the quotient and we'll get the degree of operating leverage, which is 5. Now what this 5 tells us? 5 represents the number of times the profit is to the contribution margin, or rather the total contribution margin is 5 times of the profit. Now with that we can already calculate the percentage of change in operating income. Now in the problem the sales were expected to increase by 20%. So what is the percentage of change in operating income? It is the degree of operating leverage times the percentage change in sales. So 5 times 20% is equals to 1, or 100% increase in operating income. So what this figure tells us? So when the sales changes, we want to calculate already the operating income or the change in operating income, then the DOL or the degree of operating leverage will be very useful. So let's just get the percentage change in sales and times it by the degree of operating leverage, because the degree of operating leverage tells us how the income changes with respect to the changes in sales. So we have here 5. So 5 represents the number of times the income will change if there is a change in sales, times the percentage change in sales, which is 20%, then we'll have a 100% increase in operating income. So if there's a 20% change in sales, we'll get a 100% increase in operating income. So that is what degree of operating leverage tells us. Now with all those topics, we're going to have one last comprehensive example. Now the comprehensive example is next. So Abernathy Incorporated produces nail polishes. Each bottle sells for 5.90 pesos, and the variable units cost are as follows: acrylic base 0.86, pigments 0.57, other ingredients 0.43, bottle or packing material 1.15 pesos, selling commission 0.14 pesos. Now the fixed overhead costs are cost 34,475 pesos per year, and fixed selling and administrative costs is 6,720 pesos per year, and Abernathy sold 35,000 bottles last year. Now we are given here the following. So we are required to calculate the contribution margin per unit and ratio, break-even units in units and in sales, operating income last year, margin of safety in revenue, and degree of operating leverage. Now to compute for the contribution margin, let's determine the selling price and the variable cost. Now in the given, you may rewind this video. So the given selling price is 5.90 pesos, and the variable costs are composed of acrylic base, pigments, other ingredients, bottles, packing material, and selling commission. And the sum of all those things, and we will get a variable cost of 315 pesos, and the difference between the selling price and the variable cost will be the contribution margin of 2.75 pesos. Now divide it to get the contribution margin in percentage. Contribution margin divided by selling price will equal to 47%. Now the solution is presented here. Now let's move on to the next. Now we're to calculate the break-even. Now to calculate the break-even, let's determine first the total fixed cost. Now we are given with a fixed overhead of 34,475 and fixed selling and administrative expenses of 6,720. Now add these two and we'll get a total fixed cost of 41,195. Now this will be used in our computation for our break-even in units and in dollars. Now, to get the break-even in units, just divide the fixed cost by the contribution margin per unit, and for in dollars, fixed cost divided by contribution margin in percentage, and this is the solution. The final answer for the break-even in units will be 14,980 units, and for in dollars, break-even is $88,382. Oh, as there may be confusion, in dollars and or in any currency is just the same. It will yield all the same answers. Sorry for the confusion or the error. Now let's move on to the operating income. We're given with the sales, selling price, variable cost, and fixed cost. We can already calculate the operating income. So multiply the sales and variable cost by its total bottles sold last year, which is 35,000, and so the income statement, or the rather operating income statement, is presented here. So sales is equals to 206,500 minus a variable cost of 110,250 and the fixed cost of 41,195, and we'll get the operating income of 55,055. Now that we have the given value for the sales in revenue and break-even sales, we can already calculate the margin of safety. Now, get the difference of the sales of last year and the break-even sales calculated earlier, and we'll get a margin of safety of 118,118. Now, next is the contribution margin, or rather, for the degree of operating leverage. We have already calculated the contribution margin and also the operating income. So divide the contribution margin by the operating income and we'll get the degree of operating leverage by $1.75, or rather 1.75. So that is for the comprehensive problem. The limitations of break-even analysis. Now, number one, price reduction may be necessary to protect sales in the face of increased competition. The sales mix may change with changes in tastes and fashions, and the balance between fixed and variable costs may be altered by new technology. I hope that you have learned the CVP analysis through this video, and if you have any questions or clarifications, just put it in the comment section below and we'll gladly attend to it. I hope you learned something, and thank you for watching. This is COB channel ACCTBA3 series. Thank you.